How do you position accordingly? What do you do? What are you doing differently?
So the thing that it highlights is just the asymmetry in terms of market performance. Now, you're not going to see it realized until it shows up in the data, but it highlights that the Fed's actions and its narrative kind of conspire to push people into the same types of trades. And so when you get the surprise on the other side that might be brewing here. I'm not saying that it is, but it creates a much larger opposite reaction. I don't think you can position for that today because you got to position with the momentum, which is, hey, they're gonna cut 3 times. They're pretty sanguine, and as you've seen in the equity market today, it's everybody back in the pool.
It seems as though there aren't that many people worried about inflation getting unmoored. Everyone seems to say that doesn't seem to be the risk that we're currently facing. The Fed doesn't seem particularly worried about inflation expectations really getting out of their control. All things being equal, does that give you enough confidence to buy longer-term treasuries, 10-year treasuries, 30-year treasuries, with the conviction that the Fed will truly get inflation back down to 2%?
So just a clarification, we're not talking about inflation going back up. We're talking about the failure of inflation to go down to 2% as fast as the Fed expects it to, and therefore they can cut interest rates as fast as they need to because they are more worried about being too restrictive. So it's more about not getting as much as what the market expects than some kind of big change in terms of the inflation trajectory. On the second part of your question, Lisa, super interesting development here, kind of more minor in terms of the headline here, but that change to the longer run dot. And what you saw in the curve reaction is an attempt to try to steepen the curve. Most of the reaction is just in the front end, but you look at the back end and it was flirting with higher rates, positive yield movements to the back end. And it is this longer run story that perhaps the landing point isn't as low as what we think it is today, isn't as low as what it was pre-COVID, that the neutral rate ends up being much higher, and that the path of aggregate cuts is much lower. And then you add on top of that a lot of the fiscal considerations in terms of the amount of debt that's being pushed into the private side and the QT that he talked about, the balance sheet slowing, less support for absorbing that. That challenges the back end of the curve. So I think it's still a much more challenging environment for longer dated maturity interest rates coming out of this meeting.